is Bernie Madoff, who's the chairman of Bernard L. Madoff Investment Securities, LLC, which he founded in 1960. That name may not say a lot to you, but you go over to Madoff and you talk to Bernie and he mentions, oh, by the way, 10% of stocks traded in the United States are going through this firm right now. It's one of those really important parts of our financial system that doesn't show up in the headlines, that most people don't, outside of markets, don't understand the role it plays, but it's a major factor in American and global financial markets today. And next to him is Josh Stampfli, who's the head of automated market making group at Bernard Madoff Investment Securities. He designed the, I'm going to just read the sentence right here because it's so beautiful. He designed the trading logic to manage position risk and handle the order flow inherent to the firm's business of providing liquidity to its customers. He's going to explain what that means in a little bit.
You have to understand, Wall Street is one big turf war. So, as Elsa just said, by benefiting one person, you're disadvantaging another person. And the basic concept of Wall Street, which sometimes the regulators lose sight of, and as do the academics, is it's a for-profit enterprise. You know, in every aspect of it, the person that is buying a share of stock is convinced he knows something that the other person who's selling it to him does not know. There's no zero-sum game in Wall Street. So when Bob first started to look at market structure, whether it be macro market structure or micro macro structure, and he started asking questions of the established ways that business was done in Wall Street, no one wanted to deal with that because everybody was very happy with the way things were. You know, commission rates were you know, 80% higher than they presently are today. Everybody was making a very good living. Regulatory. So
commissions have, even since deregulation, obviously at deregulation they dropped a ton, but they've kept dropping since then?
Well, they've gone down to virtually nothing. So what you have now, outside of Mickey and a number of firms, other discount firms like hers, nobody really wants to do retail business any longer because nobody wants to do business for 5 cents a share when it used to be 75 cents a share. And Wall Street, so just so you understand the scope of it, is one of the few industries where the cost of doing business for the consumer has gone down dramatically from a commission standpoint. Yet the expenses of doing business from the industry's perspective has dramatically increased. And the cost of regulation has dramatically increased. Now, no one's going to run a benefit for Wall Street. So whenever I go down to Washington and meet with the SEC and complain to them that the industry is either overregulated or the burdens are too great, they all start to roll their eyes, just like all of our children do whenever we talk about the good old days.
You sort of raise this question, which is, okay, commissions are almost nothing, and yet you are a for-profit enterprise, and maybe we can bring Josh into it too. How do you guys make money then?
Well, today, basically, the big money on Wall Street is made by taking risk. That's where, and that was sort of, firms were driven into that business, including us, because if you couldn't make money charging commissions, primarily because the rates were lower, as I said, and the infrastructure costs, particularly the technology and the regulatory infrastructure you had to have dealing with clients. Everyone said, listen, I might as well risk my own capital and trade. So if you looked at the earnings reports of the firms like Goldman Sachs or almost everybody today, any of the big and large investment banks, the great majority of their income comes from risk taking. In other words, proprietary trading, putting the firm's own capital, providing liquidity to institutions or to individual investors, primarily institutions. That's where the money is made.
And is this something like when you're doing all this trading for other people, is that something that is, I've just never fully understood, is that a completely separate operation? Is there information going back between people who are doing the trades and the ones who are taking the bets? Or?
Well, yeah, there are Chinese, so-called Chinese walls that are required to be established at every brokerage firm, so that there are what they call information barriers, is a better term that most people would understand, to sort of wall off a brokerage firm from taking advantage of information that he has as to what clients are basically going to trade or not going to trade. So there are separate divisions within the firms, and it is very carefully enforced and surveilled, so that there are these it doesn't mean there are not abuses, for sure, but by and large, in today's regulatory environment, it's virtually impossible to violate rules when this is something that the public really doesn't understand. And if you read things in the newspaper and you see somebody violate a rule, you say, well, they're always doing this. But it's impossible for you to for a violation to go undetected. Certainly not for a considerable period of time. And when you consider the volumes of trading, the trillions of dollars of trading that go on, our firm, for example, alone, we trade in excess of $1 trillion a year. So, and that's one firm. So when you look at the scope of the trading that goes on today in Wall Street, and you look at what we would consider to be the infractions, they're relatively small, primarily because, of all the regulation. And most firms do try to comply with that.
I want to get back to regulation in a bit, but I want to put Josh on the spot finally. So basically, well, just describe what the heck you do.
Okay, so the way I view market making is, let's say you're Joe Retail and you want to buy 100 shares of Citibank or something. So you give your order to your broker, and then your broker can either send that order to the New York Stock Exchange, at which point you trade against somebody sells those shares to you, or they can send it to another destination that will sell the shares, because the broker isn't the one selling the shares. For you to buy the 100 shares, somebody actually has to take the other side and to sell those 100 shares. So we're a destination that brokerage firms route their order flow to, and then we satisfy the execution side of their customer order. And as a result, we're constantly being put into a portfolio of positions, long some stocks, short other stocks, as a result of the customer order flow. And so you have to manage that risk and work your way out of it. And that's sort of how I see the business of market making.
And how did you end up, what is your background? What does one have to do to end up building these models?
I took the wrong route, which was, I started off actually...
How did you tell us this?
Well, yeah, I still wasn't going to tell you in the interview.
You went to the first firm and they asked if you had a PhD and you said
exactly.
no. Exactly. You said yeah.
And I didn't make that mistake. But I traded bonds for a little while, and then I went to a hedge fund and fixed income and another hedge fund, and I sort of left, went back to school briefly, participated in the startup internet mania, and when I finally sort of figured out that wasn't going to work either, I'd been working at a firm where our product was an automated system to internalize a brokerage company's order flow. So the idea was maybe instead of taking their order flow and routing it out to another destination for execution, maybe the brokerage company itself should be providing some of these executions to its customer. And it was a natural fit for Madoff, because that's their business, is the providing executions on order flow. And so we, like many startups, ran out of money in the crash. We were burning as fast as we could fund, and then the funding disappeared, and so I went out and talked to some of the people that we talked to while I was with the company, and Madoff, Mark and Andy, Bernie's sons, brought me in and gave me the opportunity to build automation into their existing business.
And the way because I visited Madoff, and it's a very quiet place. Considering all, you just think of the history of Wall Street, and even now still in the Chicago exchanges, all these people yelling, and I guess I'm just struggling with this idea. What is the idea that humans are setting these policies? Like, okay, here's what we're trying to do, but then you let the computers and the algorithms take over from there because they can do it much more efficiently on a case-by-case basis, and that's sort of for both of you.
Now, where Josh comes in is, if you look at our firm as recently as, I would say, 10 years ago, all of our orders were handled, they were delivered automatically. into our firm. But what we did after that was a manual process, meaning the trader sat there, what we call a market maker or a trader, and we had, let's say, 100 traders sitting in one room, and they would make a decision: do I buy that stock? Do I keep it, or do I sell it out, or do I hedge it? What do I do with that position? And the firm is at risk during this whole time, assuming he didn't have a ready buyer or a seller on the other side of the trade. What people did is, because as profits started to become less and less, the commissions were less and less, firms couldn't afford to spend a lot of manpower in handling and processing these orders. So what we did was we used technology to be able to handle the orders without individuals. So we built, as well as we automated the industry from the delivery side, we now had to automate it as how do we turn that order around? How do we make a profit on that order? And while, it was great relying upon a very smart young person, and it was only young people, because the average burnout time from a trader on Wall Street, up until about 10 years ago, was literally 6 years. Nobody lasted on a trading desk for more than 6 years because the stress was so great. So what we did was totally automate the process, all right, and provided a tremendous amount of information through technology to help the traders make decisions by giving them all sorts of news screens, all sorts of economic data or currency. If you go to a trading firm today, they sit in front of 20 different information screens How do they understand
take all
it all?
that in? Yeah, I mean, I see that whenever
You saw that if you went to our firm. They're young and they obviously don't digest all of it properly, which is why we hired people like Josh to say, okay, look, let's take the human factor out of the equation. And some people look, when we started our firm, not with me, because I was happy enough to graduate college, but then we went through a period of time where we didn't hire anybody that didn't have an MBA, because we felt that MBAs were the right people to have working for us.
Thank you.
Then we went through another stage where we said, actually it was my wife, who said, why don't you hire, math people? Why don't you go to MIT and hire math people? Because if everything you're doing is related to algorithmic trading and those sorts of things, they're probably the best people. And that was true, but we didn't have much success with the people from MIT. They spend this has nothing to do with the institution, I believe. They spend too much time thinking. I understand that's not something you people want to hear, but that's what happened. You could actually watch them. They would be delivered an order. They're now along 1,100 shares of IBM, and you would see them. And my brother and I and my sons would look at them saying, well, and they would say, I'm getting there. And by that time, the price had moved usually against us. So we determined that the best thing for us to do was basically to take the human being out of the equation. Now, that had two advantages in our industry. Number one, when you take the human being out of the equation, you solve your regulatory problems, because the nature of any human being, certainly anyone on Wall Street, is, the better deal you give the customer, the worse deal it is for you, because you're on the other side of the transaction. It's like going into any store. The store sells you a television at a higher price, they're going to make more money. They sell you the lower price, their profit, goes down accordingly. So as honest as you can find, you try and get people to be. There's this normal, natural pull, that you have to deal with. So by taking the human being out of the equation to a great extent and turning it over to a computer to make the decision, I guess you could also program the computer to violate a regulation, but we haven't gotten there yet. The issue is by taking the human being out of the factor and putting someone like Josh to go back and run all sorts of algorithms, and he'll can explain that to you, because every time he tries to explain it to any one of in the Madoff family, we walk out of the room after 15 minutes. But that, by doing
Maybe
that,
we don't want him to do that.
Exactly.
by doing that, we were able to automate the process, and where today, just to give you an example, the scope of that, we were able to take an operation that had, he's probably going to ask me for a raise after this, where we had, let's say, 40 people, doing 300,000 transactions a day, which is what our normal transaction count would be. We have a team headed by Josh and 5 people, 6 people?
Yes, 7, I guess, including.
Okay, 7 people, handling that same thing that 50 people, might have been involved in. And this is what all market-making firms, do today. That's the way they operate.
Well, so I'm going to ask this of both of you, but I'm going to start with Mickey. So this is great. We've gotten rid of all these irrational, flawed, error-prone, corrupt people, potentially so. And also, I mean, just when you hear that old system of having to call up every single dealer, it's clearly much better in a lot of ways now. But I mean, have we reached market nirvana? Are prices set perfectly now? Is the market any safer than it used to be?
The investing has gotten so fast because the average person who used to go home and read the newspapers or read a research report or speak to his broker, who they virtually don't exist anymore. The old type brokers that you would call to speak to. That took time. That was a slow process, which I guess we'd like to go back to lots of different aspects of our life and say, does it have to be so quick? It is, but that's the reality of life.
Because doesn't wisdom come in contemplation to a certain extent? And if the information gets more, if you're constantly absorbing, if you're a trader sitting there with 18 different sources of information coming out.
Physical floors, but some of them, but they're really there. But no, there's no business really transacted on.
They have computers on their floors, and there are people by the computers.
But it's much more. First of all, it's much more efficient to operate off a floor, and the reason why it's quiet. When you went up to our firm and you said, "Well, I'm surprised at how quiet it is," and we still I find it because, find it difficult to get used to that because I'm used to a lot of noise and screaming. But when we were doing, 10% of the business that we did, we had, 1,000% more noise.
Right.
It is, so, but you go anywhere today, any trading firm, there's virtually no noise because in our firm, 99% of our trades run through automated systems like the ones Josh builds or others.
So in answer to Ed's question, we're going to get even quieter in the future?
The future is silent.
The future is silent.
That's right. The future is silence. That's true. I don't see a lot changing, in the marketplaces. I mean, we've pretty much, and it's hard to, of course, say that because, everything always changes, but I cannot, imagine what else, from an automation standpoint, even in the clearing side of the business, here, Europe has a lot more further to go on the clearance and settlement of transactions, but on the actual trading, if you go to almost any brokerage firm today, any trading firm, whether it be mine, whether it be Goldman Sachs or anything else like that, the technology I think, is pretty much as good as you need to have. This is a psychoanalytical group, I guess, right? Isn't it?
They're 1 or 2.
1 or 2, okay. I'm sort of curious, maybe because nobody had a chance to ask any questions about, yet. But as to what has changed from, what do human beings contribute to the marketplace? Is there any change in their actions or even in the professionals?
Well, that's the question I was going to ask you when you were talking before, and especially do these computer-generated programs take on a life of their own? I mean, did it become a veritable force in the marketplace?
Yes. Absolutely. And that you had an event this year in August where I sort of figured this would come up at some point. So it's sort of this idea of emotion in the marketplace and the greed and fear question, and I think that was a question that maybe popped up on the website at some point. And when you talk about, like the internet boom is a good example of human greed and fear, where you have, once people sort of realized the internet was going to be big, everybody wanted to be in on it. And so over time, the herd aligned itself all in the same direction. And it's a gradual, the alignment is a gradual process. Greed is sort of a slower, more gradual process, where everybody kind of gets pointed in the same direction. And then, at some point, valuations reach a limit. Everybody's bought that can buy. As much margin has been taken out as can be taken out. You run out of people that can continue to support the trend. A catalyst occurs. Someone within the herd turns around. And now, all of a sudden, the market goes down, say. And now everybody in that herd starts to feel a very sharp pain. And the greed, again, is a more gradual process, because you may say, hey, it's up 10% this month, or it's up 20% next month, and look at the money I could have made. But it's not, you don't have to be in the markets. So the orientation, the initial orientation of the herd is a gradual process, but the pain is immediate. And when people see that they're losing the money that they think was really earmarked for their house or their car or their kids' education or their retirement, it gives a sense of urgency to their action. And that's why markets fall much more quickly than they rise, because all of a sudden everybody in the herd needs to turn around and run for the exit, and the door simply isn't large enough for everybody to get through. With computerized models, you almost exaggerate that the greed and the fear, because it's sort of a paradoxical statement that computers would feel more greed or more fear than human beings. And in some ways, I think it's because of the reason why people value computerized trading, which is the discipline of the machine. It sort of gives it lends itself a confidence, and it standardizes the model. So if you look at in August of this year, there was a big dislocation due to quantitative funds. They pick longs and shorts, very diversified, longer-term funds that are all based on computer models. And what had happened, it was something that sort of evolved over a long period of time, where people first started looking at this maybe in 2000 or a little before, these particular type of sort of longer-term fundamental quant models. And the returns were good, and more people went into the strategies, and so the funds themselves were raising more and more money, and they're sort of self-supporting, because it's a mean reverting strategy. So essentially, it's people buying cheap stocks, selling expensive stocks. And when you buy a cheap stock and it declines in price, it actually looks cheaper at that point. So you buy more. And so what you have is, as more and more money flows into this strategy, they become self-supporting. So if I bought a stock and it goes down a little bit, well, I know that I'm going to buy more, and 10 other funds are also going to buy more. And it tends to dampen the volatility. So these funds had a very nice characteristic, that they were succeeding. They had low volatility. They didn't suffer big losses because they were all sort of self-supporting. But what was really happening was that over time, all of these funds that were pursuing a similar strategy were orienting themselves in the same direction. And because they're all quant-based, everybody's looking at the same data. Everybody's doing the same analysis. Everybody uses essentially the same statistical techniques. The models end up being very, very similar. And the nice thing about having people controlling trading is that people are idiosyncratic. So even though I like the internet, you like the internet, everybody likes the internet, we all like different aspects of it. We all express our views in sort of our own idiosyncratic ways. But the nature of the quant funds, when all the decisions are being made by the algorithms, and all the algorithms are fundamentally the same, is that the herd gets very concentrated, very strongly oriented in the same direction, because of the success of the strategies. And because of sort of the low volatility, people were willing to increase leverage in the strategy. So they were magnifying their own events. And that also further concentrates the herd, because you have a small number of very large animals now that are all pointed in the same direction. And so when you got that break in sort of late July and August this year, which was actually, I think, probably due to something completely unrelated, the subprime problem, maybe it hit some other aspect of one of these funds and they had to liquidate positions to raise capital because of losses somewhere else. That was the catalyst where all of a sudden one of these very large animals had turned around, and now everybody running these strategies and everybody that had levered up and were committing an awful lot of capital, all of a sudden all of these bets that they thought were uncorrelated all became exactly correlated. Because if they all have the same bets, once one company starts selling all the stocks that it owns and buying back all the stocks that it's short, those are all the stocks that everybody else has the exact same position in. So now the fear was, you get this enormous magnification where
It's like a storm. Actually.
yeah,
Pressure.
Yeah.
exactly.
Weather.
You build up, and then you sort of have this very turbulent explosion where everybody's suffering the exact same losses at the exact same time. And you like, I read a story on Friday actually, where Goldman Sachs guy said it was, he looked at August as I think he called it a 25 standard deviation event, the type of thing that would only happen once every 100,000 years. But again, that's based on the assumption that all these bets were uncorrelated. But the problem is that when the entire herd's pointed in the same direction, and you're just like the big animal next to you, and one of those animals turns around and starts running for the exit, all of a sudden everything runs against you, and the fear explodes, and you get one of these very sharp market moves.
Oh, I'm sorry.
My question to the audience is that the professional trader, finds his niche all the time. I really don't know how the retail trader is going to deal with this global market on a regular basis, because the fear that I hear, right? My major expertise as far as advice is I handle high net worth people, and I try to give them a little advice of which side they should go on. Should they do something? Shouldn't they do something? Which is the fear that most people have. Most people that I deal with have accumulated an awful lot of money somewhere else other than the market, and now want to spend it in the market to make more money. And how that will happen as far as what's going on is really what the question is.
Well, so that's a question for.
Yeah.
Well,
Wow.
look, first of all, there's been a lot of discussion about, the speed and everything else like that. There's no reason that the average investor has to worry about that. The fact you can still make your investment decisions, and the fact that a market goes down 300 points or up 300 points, it's a scary event, and you would always assume that there's something going on that you don't know about. But take my word for the most part, you can ignore all of those moves. Because if you go back historically, you look at the long-term performance of all of the marketplaces, it really doesn't matter. If you whether it be 87, whether it be 98, whether it be last August, had you just held on, and the only way you can hold on is to be comfortable with what you own.
That's true of the post-1930s era.
Well, but look, you can go
20 years.
Go back forever,
right.
but let's live in the real world.
I agree.
We have to deal with the real world that you have to deal with. If you ignored almost anything that's happened in most of our lifetimes, at least the people sitting around here, you would be fine had you just held on. So, since it's not your business, it's unfortunate for me that I have to deal with this every day. So and I have clients that do care about what happens every day. But for the average investor, you don't have to do that. If you're investing for your retirement or whatever, I said, you don't have to get involved in all these insane moves that occur in the marketplace. There are people that want to do that because that's their business, but you don't have to really get preoccupied with that stuff.
I'm actually a futures trader.
Did I front run your question?
My name is Denise Scholl.
Okay.
I'm supposed to say my name. A futures trader and a student of modern psychoanalysis. But what's the future of human capital, and what is the role? I'm somewhat directing it to Josh, but to all of you. And what is really going to be, and I think underlying what you were saying was, where is the human in that? And so I open that up to what you see is the role of the human, because there does need to be some interaction between the algorithm and the human when all the algorithms are on the same side of the trade.
Yeah, well, there's also, there's a human obviously behind every algorithm. I think in terms of the structure, as Bernie mentioned, there's just been an enormous amount of automation into the business as a whole now. So there's been a huge transformation from 30 years ago to today, and I think you said that it's not clear what more could be done. I think there's always someone behind the machine.
What's the process of turning the machine on or off? Like you take an August event when...
The August event is interesting. Actually, I don't want to, I spoke about the August event as a very turbulent event. I don't want to be seen as sort of someone who has sort of a negative view. I think, honestly, for the retail investor, things are as benign now as they've ever been. I think the dissemination of information is the internet has been such a powerful agent to push financial information, pricing, everything that used to be sort of only the domain of the professionals now is in the hands of the individual. Maybe not the most important thing, but commissions are way down, bid-ask spreads are way down. The customer gets a faster and a better execution now than they've ever gotten before. I think in general, it's benign, and even the concentration that you see, and I believe the danger is when the herd's all pointed in the same direction, but I think on a macro scale in the markets, there's more diversification of the herd than there's ever been just because there's so many more different participants. And it's just kind of in these very isolated little segments. I might have strayed off topic.
Let me reassure you something that I can, as his theoretical boss, I guess, the issue is...
Not theoretical.
What are you doing for dinner, Josh?
Yeah.
My theory, and I've always said this, even though we were one of the ones that started all this automated trading and algorithmic trading, was that I never wanted to get into a cockpit of a plane and see that there wasn't a pilot sitting there, regardless of that I knew the plane was going on autopilot. Right. So behind every algorithmic trading desk, obviously there's somebody is writing the algorithms, the systems, somebody's doing that. But more importantly, from our firm, and I don't know that we're unique, but I know there are other firms that do not operate this way. We have a group of traders that are watching the systems work and the results of the systems to make sure that from their sense of trading, things look right. And with all due respect to Josh and a lot of other people that we have with similar backgrounds of Josh, programmers and not that he's a programmer, but people of his ilk, all right, can tend to believe, we feel as practitioners, too much in the math and in the model. They fall in love with it sometimes. Not so much Josh, which is why he's with us, but we have a lot of people like Josh that we employ and deal with. So, and they're different. And the thing that separates somebody that is a good algorithmic trader from somebody that is dangerous is somebody that just always believes the machine is right. And there are people that way, and we do have some that say, I don't. And it goes back to what Bob said about the joke of the dog. It's supposed to make sure that nobody touches the machine. It is you always want to have the human factor involved in the process because that makes it better. At least that's been our experience.
I agree.
Yeah, absolutely.
We have another question.
Yes, I'm Darryl Montgomery. I'm the organizer of the New York Investing Meetup. It's a group of 1,200 people that's in New York City. We're all independent traders and investors, and this is sort of where things have gone. We only exist because the internet exists. These are people who trade their own money and work independently mostly, or just want to invest. They want to make their own investment decisions to some level. My question is about bubbles and crashes, how technology is influencing this, and it looks like it's making the possibilities much worse. And I'm specifically talking about 2987 and what can be coming in the future. Since people haven't changed, I assume crashes are going to still exist. And right now we have massive bubbles forming in mainland China in the Shenzhen and the Shanghai markets, which are going straight up and blow off tops. That bubble has spread to Hong Kong, which has gone up almost 50% since the Fed first rate reduction in mid-August. That is spreading to the rest of Asia right now, where a number of markets have hit all-time highs. I would like comments on this and how bad crashes can become now compared to the past and how much faster they can become.